goodness, silver's taken off. So the SLV is shorted by the banks. Well, think of how much silver is in there. Large bullion banks often run a matched book across venues. COMEX futures, London over-the-counter forwards and swaps, options, physical, exchange for physical leases. So the visible COMEX short does not prove their naked short in any simple way. Where is the deliverable metal when someone demands it? That's where the paper versus physical stress shows up.
We see in Shanghai the same happening. So are these signals then that we are indeed experiencing a shortage of available silver?
Does that mean we run out in 1 year? We'll never run out of silver. But it does show you the tightness in the market because the above ground supply of silver is probably close to 3.5 or 6 billion ounces, according to the Silver Institute.
So we did see, especially just before the crash happened, we did see more people selling than actually buying silver.
Explicit U.S. policy that says, we're going to block Latin American silver to China.
What's the incentive then for these banks to manage the silver market instead of other commodity markets? I mean, I get it with gold because that's sort of the canary in the coal mine, the barometer. So central bankers want a low gold price, or at least they don't want it to get it out of control. So is it because silver is also partially monetary metal that they are that interested in silver?
Again, it's speculation. I think that's part of it. I don't think anyone has a real answer. I think that they go kind of hand in hand because I do think, and this is just my speculation, that if silver ran all by itself and gold didn't participate, I think there'd be a lot of raised eyebrows. What the hell's going on? Because a lot of people think of silver as money or a safe haven. Some do not. But nonetheless, I think the banks think, oh my goodness, silver's taken off. So I think they need to keep it kind of subdued relative to, what gold does. But again, no one really knows. I mean, there's a different why for different, entities. I mean, there's why was silver capped for so long? Well, why?
Silver isn't just a commodity. It's treated like a monetary pressure valve by banks, quietly managed alongside gold. David Morgan highlights that central banks fear uncoordinated spikes because silver's monetary perception could trigger investor alarm. Historically, attempts to decouple silver from gold caused volatility in hedges and ETF flows. For long-term investors, this means markets aren't purely free. They're subtly guided, and paper positions could obscure real demand. Next, David Morgan teases why silver interventions often go unnoticed until sharp price moves shock the market.
One of the big whys that's pretty factual is the Silver Users Association. I mean, back in the day, the Silver Users Association was a group of silver users from industry that's mandate was to basically price low so that they had a great margin on the manufacturing that they did using silver as a key component to what they were producing. And that's gone away, but that whole idea of, I don't want to have to pay too much for silver because it will cut into my profit base. So that's part of it as well.
Yeah. And what you said earlier, so basically silver and gold are joined at the hip. So they if they want to control the gold market, they should also try to control the silver market because they cannot separate too much from each other in terms of price development.
Correct.
Yeah. The other day, I talked to a former JP Morgan trader, Robert Gottlieb, and he said, unlike what's being said in a lot of silver, on silver YouTube channels, for example, is that banks in general are not short, net short silver because they may be short on COMEX, but then they offset that with a long position in London, for example.
Industrial users once held a hidden lever on silver prices through the Silver Users Association, quietly prioritizing margins over market signals. David Morgan notes that today, gold and silver are joined at the hip, meaning that attempts to move one without affecting the other create complex arbitrage pressures. Offsetting COMEX shorts with London longs shows banks hedge across global markets, reducing naked risk exposure. Investors need to factor in these multi-venue dynamics when evaluating price spikes or dips. Next, David Morgan examines why these hedging structures complicate the perception of short positions and risk.
But you said earlier that quite a few of those banks probably were too short and they were squeezed when the price went up. So Help me to understand this. How can this be sort of joined, these two different theories?
Yeah, I agree with the concept. Large bullion banks often run a matched book across venues: COMEX futures, London over-the-counter forwards and swaps, options, physical, exchange for physical, leases. So the visible COMEX short does not prove their naked short in any simple way. You can, in fact, I got in, I wouldn't say an argument, but a discussion with the late, great Ted Butler on, we don't really know their real true position because, yeah, we know their COMEX position. It's public data, but we don't know what they're doing on the market. So I agree. The banks are not nearly as naked short as most people are led to believe over and over and over again by people that don't know. Banks abhor risk. They do everything they can. So you could look up different things on the web, but there are people that have been in the industry that have talked about the SLV is shorted by the banks. Well, think of how much silver is in there.
Visible COMEX shorts mask the real complexity of bank positioning, which spreads across COMEX, London OTC, and physical markets. David Morgan reminds us that large bullion banks rarely run naked shorts. Public data only shows part of their exposure. These multi-venue strategies dampen volatility but create a misleading narrative online, where banks are short is repeated without context. For investors, this emphasizes that reported shorts may overstate risk and that hedge positions can insulate portfolios from temporary squeezes. Next, David Morgan teases how calculating true exposure requires analyzing swaps, options, and physical leases together.
So right now, the net short position, last time I looked, it varies day to day, week to week, month to month, but it was 35,000 contracts net short from the banks. So if you multiply that times 5,000 ounces per contract, that's 175 million ounces. There's roughly 100 million ounces on the COMEX alone, not counting what's in London. So does that cover the complete amount short? No, it doesn't. But if you add London to it, it would. So I'm not saying they're hedging, but what I am saying is this idea that they're massively naked short and they're going to be taken out because, the price is going higher and have to cover. Now, when I said some of the banks are covered, it was. Some were. But it doesn't mean all of them. And it doesn't mean all their shorts either. Remember, these banks are both long and short all the time. And they're very savvy about their longs. They're less savvy about their shorts. So they're making trades that maybe they're making a profit on the long side at the same time that the market's going up. And so there's a lot more to it than, the banks are super short and they're going to get killed.
Headlines calling banks massively naked short ignore that 35,000 COMEX contracts, roughly 175 million ounces, represent only part of a global position, including London. David Morgan points out that many banks hedge dynamically, profiting on long exposures while shorts remain managed. This undermines panic narratives and shows markets are not purely speculative. They are engineered with risk management in mind. Retail investors should recognize that naked short fears rarely translate into immediate market shocks. Next, David Morgan will explain why understanding cross-venue hedges is critical before assuming a short squeeze is imminent.
They are the best of all at trading. They have the best math, the best algorithms, and they also have the establishment on their side. If something doesn't look very good or maybe it's going against them too strongly, who knows? You might have a circuit breaker failure and shuts down the whole system. Something can happen. You just never know.
But that didn't happen with when the price dropped that dramatically on the 30th of January. We didn't see the trade being halted like you would expect, right?
Right. Yeah, there's a YouTube video on that on my Twitter feed. I don't want to go into it here, but I do want to make two important caveats. We cannot measure the COMEX bank position. The CFTC's bank partition report for February 3rd, 2026 shows banks as a group holding a large share of COMEX silver open interest on the short side. For COMEX silver futures, U.S. banks were 10.8% of the total open interest short. So that's only 11%. And non-banks, the other side of the trade, the funds were almost 30% short. So the bank total was maybe 39% total.
Institutional control in silver markets is often overstated in public narratives, but the numbers tell a nuanced story. David Morgan points out that US banks held only 10.8% of COMEX silver future shorts on February 3rd, 2026, while non-bank funds accounted for nearly 30%, meaning banks were less than half of the total net short exposure. This underscores that market moves are influenced by multiple actors, not just big banks. For investors, this means risk management should focus on overall market positioning, not sensationalized claims. Next, David Morgan highlights why understanding fund versus bank distribution is critical for interpreting price signals.
So hedged doesn't mean risk-free. And they are hedged on some of their stuff. But again, that doesn't mean risk-free. So if the hedge is in the London over-the-counter market, you're now talking about counterparty collateral liquidity risk, which London has. And in a squeeze, the basis, the least forward curve, can dislocate, which is what has happened. So yes, banks can be short and long, but the market still has to answer one question. Where is the deliverable metal when someone demands it? That's where the paper versus physical stress shows up. That's what had been happening until the paper thing took over that we're discussing, and it's not over yet. I think the war is on and the battles are in force. We, the physical people, entities, participants, have won for a few months. And now the paper people, entities, have won. So we won battle one pretty significantly. They're winning battle two, and there will be more. But at the end of the day, that overused expression, physical wins. And we will see that in the future.
Yeah, because you've always been a fan of physical, of course. You said if you can't touch it, you don't own it. You've said that many times in the past. We do see also in COMEX that the open interest in silver is going down over the past year or so. So it seems like there's less demand then for paper trading.
Hedging is no guarantee of safety, especially when counterparty and liquidity risks exist in London OTC markets. David Morgan emphasizes that the real test is whether deliverable metal is available when needed, highlighting the tension between paper and physical silver. Declining COMEX open interest suggests a shift toward physical holdings or lower speculative demand, which affects supply dynamics and investor confidence. For portfolio risk, this means relying solely on paper positions could mask real-world delivery constraints. Next, David Morgan will explore why the physical market battles are far from over despite temporary wins.
Is that correct, that conclusion?
Yeah, in fact, I saw that when I started the Morgan report. What was so fascinating to me was how little cover ratio there was in the silver market. I got to remember, it been about $5 the ounce for 20 years. I mean, there was nobody interested in the silver market at the time that I was and Ted Butler. I mean, we were probably the only two on the planet. I'm exaggerating, but it's pretty close to the truth. Nobody was thinking about silver at the bottom. And I was, and as said Ted was. But what I noticed was there was no bank participation had given up on the trade. And I thought, wow, what a great entry point. And I thought at the time, the reason for that was there really was a very small supply of silver available for investment. That was partially true. But as things started rolling and China came in and needed, all kinds of commodities, the mining sector just took off and the production of silver ramped up rapidly.
Yeah. And so now, because you also wrote about physical constraints, we see COMEX and LBMA, when it comes to the eligible stocks, going down. Also, we see in Shanghai the same happening. So are these signals then that we are indeed experiencing a shortage of available silver?
Silver's historic lows around $5 an ounce masked a near total absence of institutional participation, offering a rare entry point for informed investors. David Morgan notes that as Chinese demand surged and mining production ramped, physical shortages emerged across CME, LBMA, and Shanghai, driving down eligible stock inventories. This underlines that market pricing often fails to reflect real-world supply constraints. Investors should view low volume periods as opportunity windows rather than purely market sentiment. Next, David Morgan explains why current inventory declines are more indicative of structural scarcity than temporary fluctuations.
Well, we've been in a deficit for 4 or 5 years, roughly 200 million ounces a year. And so where are the stock flows at the COMEX, London, and Shanghai? Where's the silver going and how much is available? So if we look at the COMEX, the reported most recent for the registered category, which is a dealer's stockpile that's approved for delivery, is about 93 million ounces. The amount in the London market is about almost 900 million ounces, but about 700, approximately round numbers, is in the ETFs, ETPs. So the total free float in London is probably around 200 million ounces, 100 million ounces. No one knows the exact number. It's not a very big number. And then on the Shanghai exchange, the HFFE, the Shanghai Futures Exchange, visible delivery inventory is at a very low, probably one of the lowest in histories. As of February 13th data, cited by Live Mint on the Shanghai Futures Exchange, was about 11.4 million ounces. And Bullion Vault and Heraeus commentary also noted tightness in the Chinese silver market and signals toward backwardations.
Silver deficits are no longer theoretical. 200 million ounces annually have been missing from global supply for several years, pressuring real availability. David Morgan points out that while London has almost 900 million ounces in total, around 700 million are locked in ETFs, leaving a free float closer to 200 million ounces. In Shanghai, deliverable inventory is just 11.4 million ounces, highlighting acute physical tightness. For investors, this suggests price signals will increasingly reflect scarcity rather than speculation. Next, David Morgan will analyze how backwardation trends hint at growing delivery stress in global silver markets.
So you're looking at the Shanghai Metals Exchange, I think, is about 10 million. I just did a video on it last week. I'm doing it from memory. Total there might be 20. London, 200 at the most, maybe more like 150 or 100. The CME below 100. So you're looking at, say, round numbers, 200 million ounces. Right now, things change. Available, well, that's 1 year's, net on an average year deficit. So all that does is cover the deficit for 1 year. Does that mean we run out in 1 year? We'll never run out of silver. But it does show you the tightness in the market, because the above ground supply of silver is probably close to 3.5 or 6 billion ounces, according to the Silver Institute. But most of that is in coin or medallion form, well over 2 billion ounces. The bar form of all bars is about 300 million ounces. And so you've got about 2.5 billion ounces that is in small investors' hands. And then you've got the ETFs again. So really the amount that's available is small. So just want to make that clear.
Yeah, I did notice as a bullion retailer myself in Europe that when these prices hit $100 per troy ounce, and even before already, you see some of these long-term silver stackers that had been waiting for this moment for ever since 2011 or sometimes even since the 80s. They were finally taking some profits.
Surface-level supply figures hide the real scarcity investors face in physical silver markets. David Morgan notes that while global above-ground silver may approach 3.5 to 6 billion ounces, only about 200 million ounces are immediately available across Shanghai, London, and CME combined, covering roughly a single year's deficit. Most silver is locked in coins, ETFs, or small investor hands, leaving the deliverable pool exceptionally thin. For portfolios, this emphasizes that available does not equal accessible, and strategic timing is critical. Next, David Morgan will detail how long-term stackers shifting to profit-taking affects short-term liquidity and price dynamics.
So we did see, especially just before the crash happened, we did see more people selling than actually buying silver with us, and a lot of above ground stock was made available basically by retail investors. So of course that's the nice thing about about a market, that a cure for high prices is usually also high prices.
Exactly.
Yeah. And what about, you also hear refiners saying, look, we cannot accept your scrap metal at the moment because we just don't have capacity. Like in Europe, I know a few silver refiners that basically tell you have to wait 8 weeks before it can be refined. So perhaps there's also like pent-up scrap metal waiting to become actual supply, or?
Yeah, as the U.S. trying to limit silver flowing, and what's a refining situation? So I don't see any clear public evidence of a direct, explicit U.S. policy that says, we're going to block Latin American silver to China. But we do see some interesting things. One, strategic and defense ideas that, now silver is a critical metal or strategic metal. That primarily means for defense purposes. And it's pretty well known that the U.S. will probably stockpile silver beginning at some point in time, and how much and how fast we don't know. Trade enforcement, sanctions, architecture, and export controls are taking place on both sides. China's put up this export situation.
Short-term market liquidity is being shaped more by operational constraints than by policy headlines. David Morgan emphasizes that refiners, especially in Europe, face 8-week backlogs on scrap processing, which temporarily releases metal into circulation, but creates artificial timing gaps. While retail selling adds available supply, structural bottlenecks and emerging strategic stockpiling by the US signal that long-term physical scarcity could persist. For investors, this means pricing swings may be amplified by operational rather than speculative factors. Next, David Morgan will examine how export licensing and strategic stockpiling could reshape global silver flows.
It's not saying no exports. That's a misnomer. What it is saying is everything that's exported, we want to know about it. So you have to be licensed to export silver. It doesn't mean they're cutting off the West. I mean, think about it. If you are XYZ Mining and you have had a basis relationship with Chinese refiners for 20 years, 10 years, you're going to ship your concentrate over to China. You're going to get your concentrate back per contract. And the entity that you have refining your silver concentrate is probably well known and already licensed. What this licensing thing is just get a better handle on how much is being exported or comes in and out, and where does it go out to. So that thing is overblown. I mean, people thinking they're not exporting silver from China is ridiculous. The quiet power of offtake finance and friend-shoring contracts are taking place. At what level, nobody really knows, but people I trust in the industry with, let's say, suitable flows of silver, not, majors like, Pan American or Fresnillo or some of the big ones, but some of the more modest mines are getting approached for offtake agreements, sometimes above spot, to take silver from that mine directly. In other words, doré or concentrate goes straight to China. It does not come out because that's the agreement. We want to buy your complete mine supply over the life of mine, over the next 5 years, or the next 10 years, or the next 6 months, whatever the contract. Is that pervasive? No. Is it everywhere? No. Is it taking place? Yes. Where is it taking place? Primarily in South America.
Licensing requirements in China are widely misunderstood. They are tracking mechanisms, not export bans. David Morgan points out that long-term offtake agreements allow mines to send concentrate directly to China under contract, sometimes above spot, ensuring continuous supply while giving the illusion of scarcity. This structural dynamic shows that market perception often diverges from operational realities, particularly for South American silver flows. Investors should interpret headlines carefully and focus on contract structures affecting available metal. Next, David Morgan will reveal why these offtake agreements may constrain global silver liquidity for years despite stable headline exports.
So on the refining capacity, the U.S. does have meaningful capacity, but reported by the United States Geological Survey, they report 24 U.S. refiners producing commercial grade silver with an estimated output of around 3,000 tons, which is roughly 96 million ounces, from ores and concentrates. In metals focus, the LBMA have mapped North America gold and silver refining capacity and participate, showing a real industrial base, but also one distributed across multiple operators and feed types. So there's 24. Are they producing? Yes, 100 million, approximately round numbers. So could the U.S. have soared more? In principle, they could have soared more, especially if incentives rise, which they are with the critical minerals tag. But in practice, bottlenecks show up in logistics, permitting, feedstock chemistry, because some ores are easier to refine than others. Many have what's called nasties. It's a slang term.
The US has substantial silver refining capacity, but operational bottlenecks limit throughput despite nominal capability. David Morgan notes 24 commercial refiners produce roughly 96 to 100 million ounces annually. Yet feedstock issues, permitting delays, and complexer chemistry create practical constraints. While incentives from critical minerals policies could increase output, real-world limitations mean supply adjustments are not instantaneous. For investors, understanding these industrial bottlenecks is crucial for anticipating how physical supply will meet demand under stress.